Every empire claims its money is safe. Every government insists its promises will endure. History keeps disagreeing. From Rome to revolutionary France, from the Confederate South to modern Lebanon, people have opened their eyes to salaries that buy less, savings that buy nothing, and rules that suddenly move. Collapse isn't rare in monetary history, it's recurrent. The real question isn't whether systems fail, it's how you position yourself when they do. We stare at bank balances and national currencies as if they were bedrock. They're not. Money is organized trust, and trust can evaporate in a weekend. That's why history matters. Each failure leaves patterns about what protects wealth and what turns to dust. Look closely, and the survivors aren't the most trusting. They're the first to test assumptions. Byzantium, when reliability erodes. The Byzantine Empire, Rome's heir, ran on the gold solidus, a coin so reliable it became medieval Europe's default settlement asset. Reliability is a policy choice, not a miracle. After centuries, officials quietly reduced purity. At first, few noticed, then merchants did. Confidence cracked. A reserve unit became a political token. Debasement didn't just change a coin, it rewired incentives, pushed trade to alternatives, and raised the premium on assets the state couldn't alter. Lesson 1. Paper edicts don't anchor value. Scarce, hard-to-inflate assets do. In periods of dilution, capital migrates toward what governments can't cheaply reproduce: land, high-grade metal, productive capacity. Pandemics, shocks that reshuffle the board. The Black Death, 1347 to 1351, killed a vast share of Europe's people. Economic effects were asymmetric. Labor scarcity lifted wages and bargaining power. Land and housing values reset. Households with liquidity could acquire productive assets at new prices. Modern echoes. During COVID, supply chains faltered, fiscal and monetary fire hoses opened, and asset owners recovered faster than wage earners. Shocks redistribute toward those with cash, credit access, or flexible skills. Too big to fail, until it fails. In 1340s Florence, elite banks lent heavily to rulers like England's Edward III and discovered a permanent truth: concentrated credit risk plus political borrowers equals fragility. When sovereign payments stopped, reputations and scale offered little shelter. The same pattern reappears centuries later, from Lehman to regional bank runs, because the plumbing of maturity transformation is structurally pro-cyclical. War finance, when paper meets inflation. The American Civil War ran on money as much as muskets. The Union's greenbacks were credible so long as issuance and confidence stayed aligned. Inflation rose as supply outpaced trust. The Confederacy printed far more with a narrower tax base and weaker collateral. Inflation went exponential and the currency died. The protective assets weren't slogans. They were food, land, bullion, and claims on production. Revolutionary France, the Assignat experiment. Assignats were backed in theory by seized land. In practice, repeated issuance outpaced collateral and enforcement. Prices accelerated, farmers refused paper, and distributional conflict returned to the streets. Credibility isn't declared. It's earned by rules you're willing to keep when it hurts. Asia 1997. Currency mismatch bites. Borrowing in foreign currency while earning in local currency works, until the peg breaks. When Thailand's baht slipped, dollar liabilities ballooned. Contagion spread via balance sheets. The lesson is brutally simple. Liabilities in someone else's money are a lever that can turn a shock into a spiral. Lebanon 2019 to 2021. The door can shut. When banks freeze withdrawals, you learn a hard fact. A deposit is a loan to a bank. If confidence dies, convertibility becomes policy-dependent. Those diversified abroad, holding real assets or safe cash outside the system, were less trapped than savers with all claims inside one jurisdiction. Modern refrain. From 2008 to 2020 to recent regional bank runs, the cycle repeats. Leverage builds. A catalyst hits. Authorities choose which claims to honor, and the distribution of losses is political as well as financial. What actually protects? History shows different tools for different shocks. Hard assets against debasement, liquidity against fire sales, diversification against jurisdiction risk, low foreign currency exposure against FX spirals, skepticism toward guarantees that depend on tomorrow's vote. Opportunity and tragedy arrive together. Prepared balance sheets buy what forced sellers must relinquish. But resilience isn't only what you own, it's what you can do. Producers of essentials, food, repair, logistics, convert skill into income when spreadsheets melt. In crises, money's unit blurs. Usefulness doesn't. Protection is the mix of real assets, real skills, and realistic assumptions about institutions under stress. Every crisis transfers wealth, from the credulous to the prepared, from paper to productive value. History won't repeat exactly. But if you treat money as bedrock instead of conditional trust, history will rhyme at your expense. If this reframed the way you think about risk, subscribe. There's more in the archive of the past than in any forecast.